Hope everyone is doing well. This is going to be a video over July the 22nd. So, overall, we had a bear bar on the daily chart. We gapped up, broke above the neckline of the June 28th high. Had two consecutive bull closes here, and we got a bear bar. Even though we got a bear bar, this is still a tight enough channel that, you can say it's two legs up. It's a micro channel, which increases the probability that the first versatile down is going to fail. And the bears, realistically, they need some sort of micro double top before the market can sell off. This is just too tight of a channel. And let's see here. So because of that, on the open, it increased the chances of any sell-off or bear trend having a tail. When you have with the exception here, typically in a tight channel, if you get a bear bar, you will get some form of a tail below. And so just buying into the close is really all it is. So anyways, on the open, we had it was a bear trend from the open. You can call it a wedge top. You can call it a lower high major trend reversal here. Some sort of left shoulder, head, right shoulder. Two-legged pullback to a lower high major trend reversal, and bear breakout led to a bear trend. The bear channel pulled back to around 50% of the channel and closed around this middle of this channel, trading range, whatever you want to call it. So, let's get into each bar. First bar of the day, it's a big bear bar, outside down. You can call it a wedge, 1, 2, 3. Again, on the open, as we all know, 20% chance in general the first bar is either the high or the low of the day, which means that this is probably not going to be the low of the day. And, before I get into all of that, one thing I do want to mention is if you go look at Al's end of day write-up, where he charts all the stop entries that he thought were reasonable. He picked selling below this, buying below that, selling here, selling here, selling here. And what you'll notice is every stop entry he picked, one could have gotten out break even if they were quick to manage the trade. Now that is when I say quick to manage the trade, what I mean is quick to avoid a loss, or as the trade turns against them. Let me just show you an example. So this bar one failed, right? Clearly, it went down and went up above it. But if we look on a 1-minute chart, maybe we'll notice something interesting. So here is the stop entry, the low of this bar, 96.75. And the market went down lower, and it started to turn up. So what that means is on this bar, the market sold off, went up a little, and sold off again and started to reverse. A lot of traders want the market to race down quickly. They want to see this bar sell off aggressively. They want to see big bear bar selling, going straight down, or this bull going straight up, this bar. And when they don't get that, they scalp out, which means, and since most bars don't do that, people naturally scalp out. So what's my point with all this? The point is there's a ton of stop entries and a ton of buy the close, sell the close bars that one can avoid a loss on because the market normally goes sideways, worst case. Now, that's a little food for thought. That's a little food for thought in the sense of the bears were able to sell, possibly get out break even. The bulls that were able to buy this close, buy above, could have been disappointed here, gotten out break even. It's the same thing as the prior day where the bears could have sold here, they could have sold more higher, gotten out break even. The bulls could have bought here and bought more lower, gotten out break even over here. Just something to think about. So I'd rather, let's do it like this. That's good enough. So here, I'll do it like that. Trying to make the bars a little wider for you guys. So again, first bar, probably buyers below, outside up, but big bar, big risk, top of a channel. Do you really want to be risking, what is this? This is 93 to 40.10, so that's 17 points. You probably don't want to risk 17 points on the open, therefore probably not going much higher. But it's reasonable buy the close bar, and it's a reasonable buy the close bar for what I just said a few minutes ago. If you buy the close and you're quick to realize that you're disappointed, you can buy more lower or get out around break even. So the bulls, they buy this close. They want to see this right here. They want to see a strong bull bar for the follow through. And when they get this, they're saying, maybe my premise is invalid. Maybe my premise is no longer valid. Therefore, I should get out of the trade. So they buy the close, they're disappointed, they buy more lower during this bar and get out right there. And that's what happened. Some bulls, maybe they bought, scalped out, maybe they got out a couple points above. But nonetheless, even the traders that held, if you look at this bar intraday, it started slowly turning down. It didn't go up and then just immediately go down. It went up, started to stall, turn, stalled a little, went back to the open, started stalling. So a lot of these moves give you opportunities and time to get out. Big bear bar. Sorry, I had to pause the video, but another big bear bar. Traders will sell that close and bet on a second leg. So anyways, to back up for a minute, the bulls, it's wedge, one, pull back, two, pull back, three, or one, pull back, two, pull back, three. I'd kind of see it as three pushes here, 1, 2, 3. Outside down, wedge, probably a few legs down. Probably always in short on this bar. Bears would not sell here. I think it's okay to sell here. Some would get out here. Other bears would get out as the market turns up. Bulls will buy. Disappointed. Outside down. So bears will sell below. Betting wants a wedge or a double top. And they want to break below this neckline or this neckline. Big bear bar. So they're reasonable to sell the close. So traders will sell this close. Had to pause it, but consecutive bear bar is probably going to get a second leg down. Bears will sell this close. Doji, reminder that we're in a trading range. It's possible 2 legs down, leg 1, pull back, leg 2. Disappointment, we're at the lows down here and here, so bears may start taking profits. Another bear bar closed above this low, so probably not going much lower, still sell the close. First low is probably going to fail, but you have to be wondering. We have a micro gap here, that's good. Bear bar closing on its low, that's good. This bar had a lot of overlap. These bars have a lot of overlap. So, sell the close, but you may get a strong reversal up. You may get a reversal up to here. We may fill this gap. And this bar might be more of a buy the close bar. And that's why we went up quickly. So it's kind of 3 pushes. 1, pull back 2. Maybe this was 2, and then pull back 3. Bull bar, strong enough bull bar, probably at least a small second leg up. Bulls will buy more lower. And we got a second leg up. Consecutive bull bars, but again, at the target, back at the signal bar here, back at these lows, 50% pullback. Just like the bears were disappointed here by the deep pullback, they sold the close, they're going to scale in. What do you think is going to happen here? Well, pretty common. The bulls, they may buy up here, get disappointed because the first reversal down is probably going to fail, and retest down here because the bears sold this high and scaled in. So we're probably going to pull back and then retest up to here. Sorry, it's I keep getting distracted with this video. The lights keep flickering, and living in Texas right now, everyone's talking about the possibility of rolling blackouts, which is kind of concerning. So bear bar, probably buyers below, testing these lows. and probably will get some sort of reversal second leg up. And, it's a high one buy. It's a breakout pullback buy, but again, tight trading range. Probably going to test up to this high and start to go sideways. Not a good stop entry buy. Not a good stop entry sell. So probably better, for most people, probably better off waiting. Second entry short, low 1, low 2. But again, forcing you to sell in the middle of a tight trading range. You can take this short. And you have to ask yourself, if you did, we may have a two-legged pullback from this rally and lead to a new high. If you sold here, what were you hoping for? You wanted to see this. You wanted to see a big give-up bar. So when you got a pause, you got hesitation. That means there wasn't a lot of sellers below the bar. Then what are some options? Well, you could be quick to just exit the trade around break even, which would save you from getting caught in this. So, and that's one thing to talk about. It's really difficult to tell people to exit quickly when disappointed and look to re-enter, because most people have trouble entering in the first place. So they finally place, you see this strong sell-off and you're thinking, gee, it's too much risk. I'm going to wait for a pullback. Now I finally have my pullback, and you're thinking, okay, locked and loaded. I'm going to sell here, put a stop up here, set a target down here, and I'm going to make my profit. And this happens, and you're thinking, how can that be? And then you're thinking, it's always in long. I got to get in early because we're going to get an upside break out of this bull flag. So we're going to get a break out of this neckline and imagine move up. I need to buy this close, and then this happens. And then that happens, and you get trapped, and you're thinking, what the heck? We had a second entry short. I was in the right direction, but then I got stopped out, and I probably reversed along, and now I took a bad buy. I was in the right direction, so now I lost twice, and I missed out on direction. So that's challenging, but the reality is one thing I really want people to understand is traders that sell this close and they see this disappointment are going to be very quick to exit and look to re-enter later. If they're disappointed by this bar and they get out somewhere around break even and they get a huge bear bar, guess what they'll do? They're going to sell. So, anyways, back to neutral. It's triangle, breakout mode, around 50-50. Look at the moving average. That'll tell you everything you need to know. This is a 20-period moving average. You get a close above it, two closes, close above it, but then, really it's a lot of overlap. So we go below it, we go above it, we go below it, above it, and tells you the probability is more neutral than it appears. And then we get an inside bar. So again, 3 pushes down, 1, 2, 3, 1, 2, 3. Bull's got an upside breakout, but bad follow through. Now it's 2 legs up and a low 2. So reasonable sell stop up there. And that's what you want to see. So if you take this trade, compare these two stop entries, this one and this one. This one, median follow through, very fast. This one, not so quick follow through. So that's what traders want to see. So strong breakout, surprise bars, Alex call it, probably going to get a second leg down. May not, is it sell to close? It probably is, but you may need to, you probably need a wide stop. Because we don't know what the bulls, what the sell to close bears are going to do here. Testing the low close. Bears got a bear breakout, so probably sell to close. May need one more bar. Breakout below the neckline of these lows. Probably going to get a measured move down from this high to here. Measured move. Sell to close, sell to close. I'm going to speed this video up. It's kind of pretty late where I am, and I'm getting pretty tired, but tight channel down. First reversal up's going to fail. Traders are confident selling here because they know the first reversal up's going to fail. And if you ever have trouble trying to pick bottoms in a bear trend, look at an inverse chart. Look at the SDS. That'll give you an inverse of the Emini. So sell to close bears, disappointed here, may get out break even here. Some bulls will buy for a scalp, betting on some kind of a wedge bottom, 1, 2, 3, some sort of parabolic wedge. But again, not ideal. First reversal up is probably going to fail. There's your first reversal up, 2 legs, or 1, 2, 3. It's a wedge. testing this micro gap right here. Another leg down, 3 consecutive bear bars, probably sellers not far above. And they got their second leg down. Outside up bar, so it's kind of a wedge, 1, 2, 3. Aggressive bulls will buy. Bears probably can get out, but probably going to find sellers at the moving average. Bear bar, bull bar, bears will close. Bears will sell it. Other traders will wait for a second leg up. The odds were you're going to get a second leg up. We didn't here, and that trapped traders, and that kind of led to this. It helped lead to that. And this is no different. You see, I'll talk about the chart. Let me try something. Anyways, I can't find the chart, but this is double top. We raced up. Typically, very common on a double top, you'll get a strong rally that tests some form of resistance and sells off. And the double top never looks like it's going to succeed. It looks like it's going to lead to a second leg. And that's exactly what traps traders. Eager bulls get long. They see this bar, they expect a second leg up, and then they start giving up when the market starts to form a micro channel, and you get this bear breakout, which is why a lot of traders probably sold here, and that's probably why Alan marked this stop entry. I believe he did. And some traders will sell this low, but probably not the most ideal low to sell or close because it's a wedge, 1, 2, 3. So if you do, tough decision up here if you get out or hold. Probably best to get out and sell again. So a lot of traders would sell maybe as this bar started to turn down below these lows. Sell the close. You can sell here. First look's probably going to fail, and it didn't even trigger. You sell this close, probably not ideal. It's a bigger bar, so bigger increased risk of a pullback. You do have micro gaps here, small gap here. So probably exhaustion, and we're going to close this gap. And you can see we did. We tested the high, second leg up, but boom. So that happens a lot in small pullback trends. The bulls, maybe they made a stop entry here. They made money buying on a stop. The bulls haven't made money buying on a stop since here, so that makes it more difficult for traders that are looking to buy. Better to wait for a strong trend line break and retest, because most buys are going to be minor. Another breakout followed through. Can you sell it? The reality is you probably can sell it for a small second leg. It's hard to do, but again, that bar right there allowed traders to decide if one tried to sell this close, they may scalp out on that. So traders could sell that close, 44.75. The low of this bar was 41. So if they did sell the close, it started to go down and started to reverse up. A lot of traders would get out for, small profit, small loss, break even. Big bull bar, but again, probably going to go more sideways than just straight up. So look what happened. Even a bear that sold here could have been disappointed here, could have sold more higher, could have sold below this bar, even though those are right next to your entries, probably not ideal. And they could have gotten out right here. So it really, if you think about it, the bears are selling closes, disappointment, and on the retest down, they're buying back shorts, betting on a trading range, especially with after all this buying. So for the most part, if I was a bear, I probably wouldn't be thrilled about selling here because, there was already the risk. This was reasonable. Even though the channel down was tight, it was reasonable for the market to fail, maybe get a second leg and reverse up. This is even more reasonable to buy. So the bulls that buy here use a wide stop. I don't know. Maybe they could put a stop here that's still pretty tight, but let's see if that worked. And you can see what happened right there and here. Bulls bought this close. They bought more lower, maybe 50% down from this double top break below this neckline. They bought 50% down, and price got back to the original entry. So either way, when you start to get reasonable buy signals, the point I'm trying to make is it becomes more dangerous to start selling below it. So I think this was a good example. Here, kind of case in point here. The bulls that bought here, it's a wedge, so might get a third push down on a wedge. Bulls that bought here, it's not all that crazy of a buy. So selling closes down here is not that simple, because the odds are bulls, and you heard Al talk about this trade in the room. He did this mistakenly. He scalped out, but it turns out it hit his target, came within a tick, and he was still long down here. So he bought more somewhere down here, got out up here, which would have been break even on both of his trades. So back to yesterday, same thing here. Bulls will buy, bulls scale in. High to buy, again, it's aggressive buy, definitely a good buy to take profits. Not the most ideal buy for a swing, but you can buy it betting on the premise that price gets up to here, maybe gets up to here, but you got to be quick to make decisions if you are disappointed. Outside down. So again, another thing to point out, small bar, small risk, probably better to have your stop below this low. It's a wedge, 1, 2, 3. You can call it a second entry short. Most bulls, probably more buyers below. It is a second entry in a trend, so, still tough call, but most bears won't sell below it. And even here, inside bar, probably going to fail and turn up. Turning up, so you can call it a triangle, 1, 2, 3. Bulls, they'll buy above it. Aggressive bulls will try and get a strong rally into the close. 3 consecutive bull bars, but one, again, body's getting smaller. Doji here, wedge, 1, 2, 3, double top here. Most bulls get out and wait for a few bars. And strong bull breakout to the upside. So bulls, maybe they buy as this bar goes above this bear flag. They'll buy as it's going up. Bulls can even buy the close, and they'll put a stop down here, and guess what they'll do here? They'll buy more lower and get out right there. But this was a warning that the market may not go much higher. The bulls really should have gotten a second strong bull bar. And by getting this warned traders that, hey, maybe I bought too high and I should scalp out. If you think about the logic, if I'm a buyer here and then I'm disappointed here and I bought more lower, regardless if I bought more lower, what am I going to do here? I'm going to probably be interested in taking profits quicker. If I see this bar and then this and then this, I don't know, that's follow through. So maybe I'm a little more willing to hold, which is why that happened. Low too short, you can call it a wedge, 1, 2, 3, bull breakout, another wedge, or a second entry. So it's kind of consecutive tops here, here, here. So here, breakout, here. Aggressive bears can sell, but when they see this and they start to see the market go sideways, those bears get out, and that increases the risk of an upside breakout, which is what we got into the close. So hope this video helps, and thanks for watching.